You're sitting in a calm harbor, but on the horizon, you see every flag pointing in the same direction. The winds are aligning. That's how I feel about Bitcoin going into 2026. Like a perfect storm, the good kind, is quietly gathering force. In my years of navigating the crypto seas, I've never seen institutional signals, on-chain data, and supply dynamics line up quite like this. So, grab a seat or keep multitasking. I'm not your boss. And let me tell you a story of why 2026 could be a major breakout year for Bitcoin. First, a quick heads up. We have a free educational Discord community, link in the description, where we nerd out about crypto markets daily. If you're new or just looking to sharpen your knowledge, hop in. It's a friendly crew. Now, back to our story. Not long ago, big banks sneered at Bitcoin. Fast forward to now, and JPMorgan, yes, that JPMorgan, has basically put on a pirate hat and declared Bitcoin the digital gold of our age. They built a valuation model that pegs BTC's worth to gold's market size, adjusting for Bitcoin's higher volatility. The result? Their analysts predict Bitcoin could surge to around $170,000 within the next 6 to 12 months, essentially sometime in 2026. Did you ever think we'd hear JPMorgan of all places throwing out a 6-figure price target for Bitcoin? It's wild, but it's rooted in math. Gold's market cap is about $28 trillion. And if Bitcoin keeps maturing into a digital gold, JPMorgan says there's a 60 to 70% valuation gap that needs closing. In plain English, if Bitcoin even captures a slice of gold's roll, the price today is way too low. One JPMorgan report even floated a long-term path to $240,000 as Bitcoin's volatility tames down and it truly goes mainstream. That's a far cry from the days of dismissing BTC as a tulip bubble. And JPMorgan isn't some lone wolf here. The broader institutional herd is waking up. Fidelity's latest survey found 76% of global investors plan to increase their crypto exposure by 2026. Read that again, not 7%, 76%. These are pension funds, hedge funds, big money players. Nearly 60% of them intend to put over 5% of their assets into crypto. That shift is insane. Institutions are no longer viewing Bitcoin as a speculative fad, but as a strategic reserve asset. We're at the point where Bitcoin is getting written into the playbooks of Wall Street and even governments. Fun fact, there's talk of national Bitcoin reserves now. The idea that countries might hold BTC like gold. How's that for a narrative shift? This institutional pivot is a huge piece of the puzzle. Think about it. 2021's big rally was driven largely by retail FOMO and Elon tweets. 2026's rally, if and when it happens, could be driven by Wall Street and even nation-states realizing, maybe we do want a slice of this digital gold pie. The launch of spot Bitcoin ETFs, BlackRock, Franklin Templeton, you name it, is making it so any investment firm can plug Bitcoin into their portfolios as easily as buying a stock. The floodgates aren't just opening, they're being carefully engineered by the biggest financial entities on the planet. The narrative is flipping from Bitcoin is risky and fringe to Bitcoin might belong in our long-term strategy. All right, so the demand side of the equation, big money interest, is heating up. Now let's talk about supply and why it's tightening like a noose, in a bullish way, if that makes sense. Bitcoin, as you may know, has a hard cap of 21 million coins. As of late 2025, about 19.9 million of those are already mined. That's over 95% of all the BTC that will ever exist. Only approximately 1 million more BTC are coming ever, and the release of that last 5% will take over a century due to the slowing emission, halvings and all. So, Bitcoin's new supply is already scarce by design, but here's where it gets spicier. Not only is new supply drying up, existing supply is disappearing from the open market. People are hodling like crazy. In the past few months, exchange balances, the amount of BTC sitting on exchanges ready to be traded, have absolutely plummeted. Just recently, over 23,000 BTC, roughly $2.15 billion, were withdrawn from exchanges in a single week, dropping exchange reserves to their lowest levels since January 2021. For context, January 2021 was in the middle of a raging bull market, a time of extreme confidence. Now we're seeing those low exchange inventory levels again. What does that tell us? It signals that investors are moving coins off exchanges where they could easily sell and into long-term storage. It's like everyone collectively agreed to lock up the cookie jar so they wouldn't be tempted to grab a cookie. With less BTC available for sale, the selling pressure eases. If new buyers come in, remember those institutions eyeing Bitcoin? They'll be fighting over an ever-shrinking pool of coins on the market. Think of supply and demand like a tug of war. Right now, the supply side of that rope is manned by a bunch of weighty hodlers digging their heels in. Available supply is shrinking, and that rope is going slack for the bears. Even a moderate uptick in demand can yank the bulls to victory because the bears' sellers just don't have as much heft as before. On-chain data confirms this. Glassnode's metrics show distribution selling has eased off considerably at current price levels, and smaller holders are back to accumulating aggressively. Big holders are still a bit cautious. We'll get to that. But the broad trend is clear. Coins are being scooped off the table and tucked away for the long term. One more supply-side factor worth noting. The 2024 Bitcoin halving, where miner rewards were cut in half, already happened, meaning the daily new BTC issuance was slashed. Miners, who often immediately sell a chunk of their rewards to cover costs, now have fewer coins to sell each day. And with the cost to mine 1 BT surging to around $94,000 due to higher difficulty, miners are feeling a profit squeeze. JPMorgan actually points out that around $94,000 has become a price floor of sorts. Below that, miners are disincentivized to keep selling because they'd be running at a loss. So even the miners, the constant source of new supply, aren't eager to dump below certain levels. It all contributes to a tightening supply dynamic we haven't seen in quite some time. Let's turn to the long-term holders, LTHs. The folks who have kept their Bitcoin stash through thick and thin, often for many years. These are the so-called diamond hands. Historically, LTHs are the last to capitulate in a bear market and the first to quietly accumulate in a bull's early stages. What they do provides huge clues about where we are in the market cycle. In late 2025, when Bitcoin's price took a nasty dive from the mid $100,000 down to about $80,000, something dramatic happened. Long-term holders unloaded a ton of coins. One analysis by Axel Adler noted that LTH sold roughly 1.57 million BTC over the quarter as prices fell toward $80,000. In just a 2-week window, around mid to late November, about 803,000 of those BTC were offloaded. That's an average of over 53,000 BTC sold per day by these long-term holders. This was the largest profit-taking event by LTHs in the entire cycle. Think about that. Bigger than any selling we saw in the prior euphoric runs. It's like even some of the most stubborn hodlers said, okay, time to take a bit off the table, when we hit turbulence around $80,000. Now, I know what you're thinking. How is long-term holders dumping coins bullish? Great question. At face value, it sounds bearish. The smart money cashing out, right? But here's the twist. Such massive LTH sell-offs tend to signal late-stage bear market exhaustion. In other words, it's often darkest before dawn. Historically, when the diehards finally start to sell en masse, it marks a sort of cathartic flush out of remaining weak hands and even some strong hands taking profits. It's painful in the moment, price-wise, but it often clears the way for the next big uptrend. Why? Because after that kind of purge, you're mostly left with investors who absolutely won't sell. The true believers. The sellers, for the most part, are exhausted. On-chain analysts observed rising seller exhaustion and historically favorable forward return conditions right as we hit those lows. It's like wringing a towel to get the water out. Once it's nearly dry, any further twisting yields little. Bitcoin's market had wrung out nearly all the eager sellers by late 2025. Glassnode's data backs this up too. When BTC slid briefly to about $80,500 amid that chaos, momentum indicators went crazy oversold. The 14-day Relative Strength Index, RSI, dropped to 18.8, one of its lowest readings of the year. That basically screams the market is way down in the dumps. At the same time, Glassnode saw signs that downward momentum was weakening and fewer traders were willing to dump at those prices. Spot market data showed a reduction in aggressive sell orders as the price stabilized in the mid-80,000s. In plain speak, the free fall was losing steam. Sellers were running on fumes. We even witnessed short-term holders, the more jittery speculators, hit a point of capitulation. November's end saw short-term traders realizing some of the heaviest losses on record. Basically, the tourists in the market packed up and left after getting wrecked. When those guys are gone and the long-term holders have already done their big sell and likely won't sell much more at low prices, you get this rare setup. Almost nobody left who wants to sell. That's a powder keg for the bulls. All it takes then is a spark of demand and boom. A coiled spring is the term some analysts use. Bitcoin in late 2025 looks like a compressed spring, pushed down by months of bearish pressure, just waiting for that catalyst to let it loose. At this point, the sellers are exhausted narrative is more than just wishful thinking. It's supported by multiple indicators. Even the team at Bitwise, crypto researchers, noted that by the end of November, many contrarian signals were flashing green, with seller exhaustion rising and the market trading in an undervalued zone. They pointed out how key support levels held and how the drawdown we saw was actually pretty in line with historical bull market corrections. In other words, what we just lived through wasn't the start of a long bear winter. It might have just been a nasty cold snap before the spring. Before we hit the climax of this Bitcoin tale, let me share a cool side quest I've been on. It is related, I promise. So, aside from devouring on-chain metrics and news, I've been testing something called Unity Nodes. It's a new tool backed by World Mobile and the Minutes Network. In simple terms, Unity nodes let you turn ordinary smartphones into nodes that help verify and improve telecom networks. Yeah, you heard right. I've got 10 phones in my house running this, doing test calls and network pings like little telecom soldiers. Why? Because the telecom industry is this giant $2 trillion behemoth that still runs on pretty clunky centralized systems. Dropped calls, fraud, expensive infrastructure, there's a lot of inefficiency. Unity nodes are like decentralized auditors for phone networks. Instead of big telecom companies setting up costly testing equipment in a few locations, anyone, even you and me with a spare phone, can run software that helps monitor call quality and network performance across the globe. It's part of this whole DPIN trend, decentralized physical infrastructure. Basically using blockchain and crypto incentives to improve real-world networks. What caught my attention is that Unity is making telecom trustless. Every test call my phones make, say it checks if a route between Dubai and London is clear, gets recorded as verifiable proof on the World Mobile blockchain. Carriers, the telecom companies, actually pay the network for this service because it helps them catch issues and fraud in real time. And the cool part, those payments go to people like me, the node operators, as rewards for contributing. It's not inflationary magic internet money either. It's funded by real telecom revenue, the carrier's fees. So it's a real business model, not just tokenomics on wishful thinking. I bought a Unity node license which gave me 200 individual Unity licenses I can use or lease out. Think of a license as a slot to run one phone node. And note, you don't need 200 phones yourself. You can share licenses or let others use them, but I'm hardcore so I'm running 10 on my own for now. Each phone equals one license active. The setup was surprisingly easy. Download the Unity app, activate a license, and let it run in the background. It's pretty lightweight on the phone, doesn't even drain the battery much or hog data. I chose to receive my rewards in a mix of BTC, ETH, ADA, and XRBP. You can pick from various supported tokens. I mean, if I'm earning crypto for helping telecom companies, why not stack more Bitcoin and Ethereum, right? So far, the experiment's been fascinating. It's early days, but seeing a notification that I earned a bit of BTC because my phone in the corner of my room helped verify a phone call route, that's the future, man. It connects to our bigger story because it shows how crypto isn't just about trading coins. It's creeping into real industries and fixing old problems. Unity nodes fit into the crypto landscape as part of that broader adoption narrative. While we wait for the financial big bang in Bitcoin, there's an undercurrent of innovation bringing crypto into telecom, energy, supply chains, you name it. often called the Internet of Things or DePIN movement. Anyway, I won't go too deep here. If you're curious, I put a link in the description to their light paper and a rewards calculator. Check it out, especially if the idea of earning crypto from your phone sounds as cool to you as it did to me. The bottom line is, I'm always looking for projects that add real-world utility to crypto, and this one caught my eye. All right, back to our regularly scheduled Bitcoin program. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile and you could lose all the money you invest. Always do your own research and consult a qualified professional. Your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. This video is for entertainment and educational purposes only. Phew, glad we got that out of the way. Now, let's bring all the pieces together and head into the climax of this story. So here we are. Institutions are lining up, Bitcoin's supply is straining, and holders have battened down the hatches. It's the classic tinderbox scenario. Any spark could light it. What could that spark be? Perhaps a wave of ETF approvals and launches in early 2026, bringing billions in new buying. Maybe the macroeconomy swings in Bitcoin's favor. We have indications that the U.S. Federal Reserve might cut interest rates in 2026 if inflation continues to chill out. Rate cuts would be a 180 from the tightening that hurt risk assets. It could be like pouring gasoline on the smoldering embers of crypto. Inflation fears, which drove many to Bitcoin as digital gold in the first place, are still on the radar of many investors. Bitcoin's fixed supply becomes super appealing when you see central banks waffling on inflation. In fact, Bitcoin's volatility has been trending down as it matures, from crazy 80% swings in its early years to something more tame lately. That makes it easier for big players to treat BTC as a serious hedge or asset rather than a gamble. On the institutional narrative side, think about where we'll likely be by 2026. Multiple spot Bitcoin ETFs trading across the US and Europe won't be some shocking development anymore. They'll be a normal part of the financial landscape. The expectation alone has already softened attitudes toward Bitcoin among investors who used to treat it like some fringe experiment. Remember that survey showing 86% of institutional investors were already exposed or planning to be exposed to crypto by 2025? Fast forward another year, and it's not crazy to imagine that number pressing toward full saturation. And if the macro environment keeps wobbling, inflation issues, currency risk, political instability, you could see more corporations quietly shifting part of their treasury into Bitcoin as a defensive play. It only takes a few big names following MicroStrategy's strategy for the narrative to flip from "this is weird" to "why aren't we doing this?" The moment a handful of household-level brands adopt BTC, the domino effect becomes real. Add the psychological angle. If Bitcoin starts clearing old highs, the media swings its spotlight back, retail wakes up, and even the long-term holders who cashed out near the top might find themselves itching to re-enter at higher prices. Market irony at its finest. Meanwhile, the actual amount of Bitcoin floating around for trading is shrinking to levels we haven't really seen before. We already talked about the drop in exchange reserves, but it's worth repeating that this isn't a short-term anomaly. It's a multi-year downtrend, reinforced by those recent heavy outflows. The pool of liquid coins, the ones that actually move, is much smaller now than in previous cycles. Some estimates point to over 73% of Bitcoin being held by long-term holders, with another chunk of around 15% tied up in ETFs, corporations, or even government accounts that aren't exactly flipping in and out. If those numbers are close to accurate, that leaves roughly 12% actively circulating. That's a thin market, and thin markets move dramatically when demand hits. It's the kind of setup where price doesn't walk, it lunges. I'm not pretending that guarantees a straight climb. Markets don't work like that. There are landmines everywhere. Global shocks, regulatory surprises, a sudden liquidity crunch, all of them can throw the trend off temporarily. But even with those risks in mind, I can't shake the sense that 2026 holds something special. It feels like we're entering one of those rare windows where multiple narratives and data points converge. Wall Street is embracing Bitcoin in ways that would have sounded absurd a few years ago. On-chain signals look like classic bottom formation behavior. And the built-in scarcity that Bitcoin has always relied on is becoming more visible and more dramatic. Here's a metaphor to bring it home. Picture Bitcoin as a rocket sitting on the launch pad. Over the past couple of years, the engines have been inspected, the fuel tanks filled, and the trajectory calculated. Institutional adoption is the fuel. On-chain metrics are the system checks. The mountain of sideline capital is the cargo. Even the weather, the broader macro environment, is starting to cooperate. Could there be a last-minute delay? Absolutely. Maybe a technical glitch, maybe a brief dip that scares a few people. But the overall structure is intact, and all the readings say the same thing. This thing is primed. And if it lifts off, it won't be a slow drift upward. Low float plus high conviction buyers plus fresh demand is the formula for aggressive upside. In practical terms, I wouldn't be shocked to see Bitcoin break old records and keep climbing well into new territory if these factors align. Six-figure Bitcoin stops sounding like clickbait and starts sounding like a baseline scenario. Even analysts who usually stay conservative have begun floating numbers like $150,000, $170,000, $200,000. When people who normally avoid bold claims begin talking in that range, it's worth paying attention. To wrap this up, none of this is a crystal ball prediction. It's an explanation for why the outlook for 2026 feels especially compelling. It's not wishful thinking. It's a combination of changing investor behavior, a maturing market structure, and a level of scarcity that's becoming harder to ignore. Bitcoin isn't just surviving its chaotic adolescence. It's stepping into a new role in the global financial system. As for me, I'm buckling in. Maybe 2026 doesn't unfold the way I expect, but right now the odds feel pretty favorable based on everything we can see. And if you've made it all the way through this breakdown, then you're cut from the same cloth as the long-term holders who've always shaped the market's biggest moves. Keep learning, stay grounded, and allow yourself to get excited. Windows like this don't open often. Hit subscribe if you're sticking around for the next one.